Good morning and welcome to the Morning Bell for Yellow Tunnel and Tradespoon. I'm Keith Harwood, and here are our normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon may have a financial interest in the securities presented and the trade ideas. So please do keep that in mind as you evaluate anything that we discuss for your own personal investment and trading portfolio suitability. All right, guys, so a little bit more bullishness again. We're getting into a little cycle here of buy, buy, buy. CPI came out well, and we've got a little bit of progress going with China. So not a lot of negativity seems to be present in order to justify a bearish positioning. Now the question becomes, what is too far too fast? Where does the bull want to take profits? Unless we get a bearish input, I don't see this market getting pressed lower. It's more about when people want to stop buying and when the sellers then need to just book some wins. Long-term investors, people looking for retirement accounts and things like that, they're not looking to sell. Generally speaking, as they get into retirement, selling in order to, finance lifestyle and everything is obviously natural. But the traditional norm with like retirement accounts is that the money flow is bullish the market. Investment flow is generally bullish the market. Long-term holders, bullish the market. Traders need a justification for the bear case. And on a stock-by-stock basis, that is clearly going to be there. Chewy earnings came out weak. That can be a bear case for today. GameStop was down. Maybe it was starting to recover, so maybe it's even up by now. But GameStop was down on earnings. That's logical. What's going to drive the whole market lower? I kind of think at this point it's going to be a negative economic input, or again, a collapse of these communications between the US and China that seem to be going smoothly. So the bull's fully in control as it currently stands, and looking for higher prices until we hit a technical resistance point, which I expect to be at the previous highs, 613 for SPY. All right. So probability of success still maintains an upside bias. Return on capital is going to be improved thanks to lower VIX. Now, the anti-bearish trade, the put credit spread, it's going to have a lower return on capital, and it's dropping because of the dropping VIX. The probability of success is increasing due to the bullish inputs to the market. That's why that return on capital is dropping for a selling options premium strategy, because the probability of success seems to be going higher for it. We're dropping out some of those possibilities of tail risk downside moves. So justifiably, we have a lower expected daily random walk behavior from the market, and so the VIX has to drop. Got to find the right technical setups to go for bull spread, bull debit spreads, or bull call positions versus those individual names that have a much more sideways behavior and have a better setup for an anti-bearish. And there are names out there that could be looked at on the short side or the anti-bullish side, i.e. limited upside. But those names can be a little bit hairy when we've got a situation like the current where maybe people start to buy up some of the stuff they've been short, and then you get in a short squeeze. So there's that risk for the anti-bullish as we get to this somewhat high RSI, high overbought, people searching for value situation. I'll address that with a couple of ideas in terms of names that could have that setup, which could be great for a trade, but not necessarily for an investment thesis. On the long side, that is. Generally speaking, got to wait a couple of days for a confirmed trend change, and right now we've got that bullish trend. We broke out of the consolidation really on Friday. So Friday, Monday, Tuesday, now Wednesday, we've got 4 days of up. Market looks bullish. Now, for those that are not looking to necessarily take profits, having a hedge can make some sense instead of reducing positioning. That is a certain logic to it. It is effectively reducing positioning by having a hedge, but if it's done so with like a put position, then there's a little bit more of a dynamic of just in case a tail risk scenario comes up, I want to have what I consider to be life insurance on my portfolio. Not necessarily dip buying insurance, where if we get back down to 595, I want to have a bunch of money and profits in my hedge. I'm thinking more in terms of life insurance. If we drop, because the US and China completely walk away from this negotiation. Or something from an economic indicator comes out bearish, and all of a sudden people are worried about inflation or stagflation again. Right now, that seems to be behind us. CPI again being on the low side helps that that concern. But never know, something's going to shift any day. So all that said, you know, being aware of earnings dates is important, and right now there's just not that many. Oracle is one that I will highlight here because Weekly Power Trader had Oracle as a long this week, but we also have earnings this afternoon. Gives me a little hesitance for the bull case, having the earnings. The AI says effectively, yeah, we are expecting earnings to be good. It knows that earnings are coming and still projected that out as a weekly buy signal. So for me, it's kind of keeping it in mind and saying, well, maybe I don't want to have that exposure, but others may want to have that exposure because that can have outsized returns as a result. We'll go through the earnings analysis on Oracle. I don't see a trade. I've been trying to find a trade in Oracle, and I just don't see a great one. But maybe Vlad will have some better ideas on an Oracle trade today. All right. Outside of all that, position concentration is going to be key here. I don't want to necessarily be all in on one sector. There's a lot of sectors that are bullish. There are a lot of sectors that are not. I want to make sure though that I'm not only in, oh gosh, you know, retail stocks. XRT looks bullish, but do I want to be 100% in retail stocks? Probably not. Do I want to be 100% in semiconductors? Probably not. Do I want to be balanced with some semiconductors, some crypto, maybe some retail, maybe some financials? Yeah, I think that makes some sense. That way, if a certain sector gets a hit on the tariff negotiations, I'm not exposed to correlated losses. All right. So with all that in mind, again, we've got the 10-year yield started a little bit firmer and dropping a little lower, staying in that range. Really seems like we're settling in 4.3 to 4.5. Ultimately, my concern point is above 4.6 or below 4.1. Below 4.1 usually would be, for me, a concern about economic growth, and that's not really in the expected, you know, test point in the near future. 4.6 starts to worry about inflation, and again, we're getting good CPI data, good PCE data, so maybe that's not a problem after all. All in all, looks like a healthy market in the bonds. We do like to look at the MMFI for a number of stocks that are above the 50-day moving average, and it continues to climb. So 78, 79, you know, above 80 starts to get pretty worrisome for me. The one caveat to that is that because the 50-day moving averages had dropped so much off of that April fall, it is natural that with this recovery, we're above the 50-day moving average in a number of stocks, in a large number of stocks, in more stocks than we were back in February. Even though we may be priced lower than February, the 50-day moving average is lower. So as that April behavior, the rally from April 7th through, you know, early May starts to wane away from the 50-day moving average, or continues to disappear from the 50-day moving average in the near future, that's going to really bring up these 50-day moving averages. And we don't have to actually go down to get below 50-day moving averages. We can just consolidate. You know, I'll give an example here, SPY. Before I go over to some Bitcoin stuff, like April 7th, that's still factored into the 50-day moving average. You know, if I count back 50 days, that is just under 50 days ago. All right. When that is the 50th day or the 51st day, we will replace a close at 503 with a close at 600. That's $100 higher divided by 50 days. That brings up the 50-day moving average by $2. Now, right now, we're $40 above the 50-day moving average. But as we start to increase the 50-day moving average by $2, $3, $4 over the course of days or weeks, over a few days, all of a sudden this 50-day moving average can start really driving higher. You know, a normal bull market that's really comfortable has the 10-day moving average in purple above the green 20-day moving average, above the 50-day moving average, above the 100-day moving average, above the 200-day moving average, i.e. all of the shorter terms above the longer terms. That takes some time to get there, but we are in that process right now. And I mean, honestly, it probably takes another 2-3 weeks to get there in bullish behavior. And that may actually require a new high in order to get there. But I think there is going to be some consolidation at that 613 or resistance at that 613 level. And it may or may not come to fruition. If we got bullish inputs that can help us push through that resistance without too much stall. But I wouldn't count on it. I do think that that's going to be a stall point myself. But stranger things have happened. And then for our other risk on barometer that I like to look at is Bitcoin. We continue to toe against the highs, so we're getting some resistance here as we press to see if a new high can be made. New buyers may be hesitant to buy at 110 when 112 was the previous high. But if these economic indicators continue to be bullish, and we continue to see a desire for risk in tech and semiconductors and AI, I expect to see a desire for risk in crypto that allows us to push through that 112 level. May take a few days. We shall see, but for now, it's still holding up near the highs after that attempt to break on June 5th. Then we saw some good data and all of a sudden back into bull mode, back into risk on mode for this broad market. So as I said, S&P's again above the previous high. Starting off bullish today, market's going to open up in about a minute, so I'm going to actually lose some of this charting for about 45 seconds. But the big key for me right now is where's my support and where's my resistance. I got some support at 595, the high from May 19th. I've got some at 590, which lines up with the low from February 3rd and the low of this, we got a little bit lower, but the low of this dip on June 5th, then 585, then 575. We got a lot of support levels starting to build up. That allows for a higher conviction dip buying market for many people. Some people will use 595 as a dip to buy. Some people may use 590. Some people may use 585. Others should have some serious support here at 575. That's a much bigger level, 595 and 575. And if we look to the upside, really the only resistance left is 613. So you can see why that honestly creates this scenario of bullish expectation. We also did have a dividend here in SPY. Last dividend about $1.75. That equates to about meaning that 612 is kind of our resistance here in SPY. If I go to SPX, just to give a comparison, the February 19th high is 61.47. So we're about $97 away. Again, about just under $10 away in SPY. So it does line up with the 613 level in spite of the dividend, but that's partially because we have some after hours trade and everything else. So, effectively we're within 1.5 to 2% of the new all-time high, continuing to march higher, bulls firmly in control, VIX falling now to 16.4. So we're getting below that 17 level, starting to look like a move down towards 14 or 13 or even 12 could be in the cards in the near future. I think 12 really requires a new all-time high with a more, this sort of stair step higher market that we're getting right now. Once we get down to towards the new highs, if the VIX continues to fall as people buy right their positions, i.e. selling calls saying they'd be happy to be called away from their long stock positions on a new high, I think it's natural to see that VIX continue to fall. If a fundamental input comes in that pulls us down to 585, 575, we could see the VIX back towards 25. So limited downside on the VIX, but higher probability of a VIX falling another couple of percent. I think, personally, I think 14.5 would be a good floor to target in this bull scenario that we've got right now. So a little bit of downside to the VIX, but generally it's a reasonable spot to start buying, to be buying calls in bullish stocks. Small caps really have kind of started to shine here. We're pressing against that 200-day moving average. Resistance looks like 220, further resistance at 230. So there are multiple resistance points in IWM to be considering here between the 200-day moving average, right where we're at, 220, about 2.5% higher, and 230, about 7.5% higher. So we got some resistance for sure in IWM. It's been a laggard. Got to keep that in mind. Some of their impactful sectors or financials, which are just unchanged right now, haven't been able to push through to new highs. Some of the small cap buying has been in healthcare, and I'm doing it again, XLV. I'll remember it one day. XLV started to get some participation here the last few days. Looks generally good here. Has a long ways to go. This is part of that recovery trade where I think people are looking for sectors that have not performed in this market rally. And it could create some short squeezes in within healthcare. So it doesn't mean that, a stock like Eli Lilly is fully bullish, but those that are short may not be able to justify that position anymore. Novo Nordisk, we may not see that shorts are fully comfortable here. We're above the 100-day moving average. We spiked yesterday. Shorts are sweating. Bears are sweating here. It could create some further upside as the bear starts to reduce their short positioning. So some of these short stocks can create that. I mean, Kohl's, I don't want to buy Kohl's, and I'll be very clear on that. But I don't want to be short Kohl's during this rally. It starts to act almost like the opposite of the falling knife, the spiking. Maybe we go into an elevator mode as shorts have to cover because maybe Kohl's can get further away from these low levels that are built on their debt concerns. Or maybe the shorts just have enough of a problem that they have to take off the loss and stop being bearish. Doesn't mean that the stock has to go to 20 or 30. Go on a longer term chart. It was a $60 stock back in 2022. I don't know that, I don't expect us to be going there. But at the end of the day, wilder things have happened. XLE has also been performing fairly well here. Oil prices have been firm, and today we do have oil prices up another $1.30. So after an attempt to reject the 200-day moving average yesterday, we're starting off above it, looking at 76 to 78 as a target zone, and that's generating some further interest in the energy stocks, which does have an impact on small caps. Tech, certainly our leader right now still, or once again, that's generally a good sign for the market bull. 540.81 was the previous high, so we're $6 away, just over 1%. Generally good to see that leadership for the bull. Small semiconductors leading tech, another good indicator for bullishness in tech. So the input to many tech firms is semiconductors. We need those to operate all of this computer tech. Having semiconductors bullish tends to be a leading indicator that tech should be bullish. And when semiconductors were lagging, that may have been a bit of a red flag. However, if I go back a full year, you can see that this high in semiconductors was actually made back in last summer, highs around 280, 283. So we do have a ways to go to get back to the all-time highs. The February high for the market was not the all-time high in semiconductors. So showing, a little bit of the lagging that we've had in that sector for the last year. There's a little bit more room to catch up, but seeing that broad participation from semiconductors is positive. And I will highlight again, Micron didn't even stall at most of our resistance points. I expected to see some resistance here at 104 or 106. Sorry, 108, 110, 111 range up to 112. None of that even slowed down this move. So there's definitely some interest in buying some undervalued semiconductors or underloved semiconductors, and we're not finding that resistance point. So the upside just seems to be that much, clearer to the marketplace. The other thing within tech, Magnificent Seven starting to get a little bit more love here. So we've been lagging the big tech. We've been focusing on a lot of things like semiconductors and smaller tech companies, more growth heavy, not the Apples of the world. And those are starting to get some love now. Apple still lagging. It's not been really any part of this market rally. That again, actually to me is a bull indicator. We're not just saying, well, if tech's good, I'm just going to buy Apple because it's safe and it's good. We're buying tech that has bigger growth prospects and it's not as mature. So buying some of that growth potential as opposed to that mature tech growth. Amazon, another good example of this, starting to get that breakout, looks very similar to the Mag 7 chart, while like Microsoft, one of our weekly power trader ideas and a aggressive power trader idea as well, up near the highs. So Microsoft generally one of the best of the Mag 7. Really like to see like the way that's looking. AVGO, another one that I like to focus on here because of its behavior. It did have weak earnings. It is showing more of a bull flag type setup here now with the higher high and the higher low. I'd expect this to retest the highs. You know, the technical formation indicates to me a retest of 260 to 265 range, with support very firm here around 237 and 237, we'll call it. The put credit spread is okay here in AVGO for 50 cents. It's not great. It's not a home run, but it can help, you know, given a high probability trade. Wouldn't do it for this week. It's not enough premium, but for next week, put credit spread looks pretty good, or a call debit spread again, targeting the previous highs. Not looking to trade for the press through the previous highs right now, especially given that we got that RSI up as high as we did on the last run. But if we breach the 260, was it 263 or 264? Sorry, 265 level. If we get back above 265, that does potentially set up some increased buying, showing a lack of resistance near the prior highs before earnings. You know, what I'm looking for in terms of a stock formation is similar to Palantir. This got through the previous high, the pre-earnings high, but then consolidated quite a bit. So I don't want to necessarily look for a leveraged upside move in AVGO without a fundamental input that tells me that AVGO is good, and it's not going to come from earnings in the near future. Earnings in AVGO is 3 months away, so it's going to have to be a broad semiconductor rally, and I think there's other names out there that can play better for a just bull call position than AVGO. Maybe it's NVIDIA. Go back to the big winner of semiconductors, just grinding higher, sitting at 70 RSI, some resistance around 150, 152 and a half, maybe up to 155. But broadly, semiconductors just honestly look pretty good here. So all in all, it's a bull market, and now it's about picking the stocks that we want to leverage that upside move. All right. Our morning sectors that are moving the best. Let's see. Well, the worst is metals. It's the biggest standard deviation move. Metals and mining getting hit here. You know, you can see like steel stocks are getting hit, NUE getting hit a bit here. So it appears that some of this tariff negotiation stuff is actually negative impact for the steel sector. You look at FCX for copper, that's getting hit too. I'm looking for FCX to have support around the 40.5 level. The high here was 40.59. The high here was 40.54. The low today is 40.48. So we did try it and then bounced off quickly. Playing around with the 200-day moving average. As long as that 40.5 level holds, you know, it's been a high that's been rejected a few times. Then upside seems to be the natural answer. But, you know, we should have some resistance at 43. So for me, FCX is either a stock trade with a stop 40 cents below, or look down to those put credit spreads, go a little bit below the, going a little bit below the support level, like a 40.39 put credit spread for 27 cents. That's or even a quarter. That's a pretty good R&R. So collecting a quarter, risking 75 in worst case scenario, generally looks okay. That's my dip buying type of trade in this broadly bull market. It means I can have some exposure saying that we're not going to collapse, or I don't expect to collapse, and we shouldn't see FCX go below 40, but I'm not buying a stock that's got a 78 RSI or something like that and exposing myself to something like what we just saw yesterday in GE. So GE started to turn negative, then yesterday, real bad day. Today, a new low. I'm staying away from GE for now, waiting for it to start to show firm support and maybe a turnaround back to showing higher highs, higher lows. That's going to take a few days. So GE, each dip has been a buying opportunity. The size of that dip yesterday, a little concerning to me. To be executing a dip buying strategy today, I'd rather let that weight off. let it get something a little clearer first. That does naturally, unfortunately, lead to Honeywell. Bit of a dip here this morning off of other aerospace selling. Honeywell has got the same GE type focus. It's got aerospace and all sorts of other stuff. Big integrated operating company. That was our paid trade for this week, and we're getting a little bit of a dip right now. Doesn't look 100% great right now, obviously. Looking to see if that can turn around. I hope so. Our timing on the paid trades is to hold through Friday, so we'll just let this play out, see if the market considers this a buying opportunity. The AI generated signals and everything all seem to be lining up, but again, some of these fundamental inputs creating a little bit of an impact on that Honeywell trade for now. And now the market's going to determine whether or not that is going to ultimately be a good trade or not. 220 really needs to hold here. The lows of this dip here on May 23rd were 220 and 82 cents. Today's low is above that. So at least there's something there to hold off with on support. Of course, 217 and a half. A bit stronger support. That was the high that we breached out here May 12th. Got through that resistance point. So minor support at 220, bigger support at 217 and a half. Either of those is still a bad scenario for a long call position. So ideally, we don't really fully retest those lower support levels. So we'll just watch that to see if we get some market buying back in Honeywell and or GE in the coming days. Since China's in focus, we've got FXI started up higher. Looked like it dipped a little bit and then back to unchanged from the market open. Naturally, Chinese stocks tending to be bullish here as we get some negotiation. So I like seeing this in FXI. That brings me back to the conversation point on silver. Silver has skyrocketed. Traditionally, silver is more bullish when China is bullish. So right now, China looks like the laggard relative to silver. I think staying away from silver makes some sense here. Gold has not been skyrocketing. It's been consolidating. There's been some potential for selling gold, buying silver. It appears maybe rotating within the precious metals sector. Little lighter buying in the gold miners relative to silver. The one that looks like the best at this time for me in that kind of bucket of looking at precious metals or China would be China. China has the most potential upside, cleanest support in order to catch up to the silver move and in order to catch up in the long-term bull market that we've seen in gold. Interestingly right now, so yeah, our biggest up move is in oil, which we've looked at, and actually the second biggest upside move is Canada, breaking out again. I couldn't tell you what EWC components are. What are their biggest holdings for Canadian stocks? Let's take a quick look. Royal Bank of Canada, Shopify. Interesting that Shopify is number 2. Let's take a look at Shopify. So Shopify actually looks really good today. Looks a lot like the broad market a few days late, right? Consolidating, shopping, and today taking out the May 16th high, which lines up pretty well with the March 25th high. Upside potential looks to be about 130. Implied volatility of 45% is near 6-month lows, but could drop towards 37.5%. It's a decent downside. So to me, this looks like an out by call vertical as opposed to a call. 120, 135 call vertical, 317 looks pretty solid. Let's see what the forecast toolbox says for Shopify. In the near term, not looking for necessarily crazy bullish behavior. We're above the expected range for today. Not necessarily something to add yet, but I expect with the breakout, if this holds today, the update on the predicted movement going forward should increase the vector and look for a higher percentage move. I think a good one to reevaluate tomorrow But as long as we hang above 112.5, that looks generally good. Going a little bit against the forecast toolbox for me would be to look to execute today. As long as we stay above the May 16th high of 112.38, I can hold overnight, reevaluate the forecast toolbox tomorrow morning or tonight. And if it starts to show some bullish behavior, then stay with it. And if not, if it doesn't see that potential bullishness after today's bull input, then maybe rotating back out. But generally, that bullishness in Canada seems to be lining up with the bullishness in Shopify. One name I wanted to pull up from the forecast toolbox that I noticed was Fifth Third Bank. So we've closed above the 100-day moving average. The May 16th high was 39.78. We're 7 cents above that right now. Yesterday we tried to go through and we kind of failed, but right now holding slightly above. On the forecast toolbox, I got FITB, projected nice bullish trend here. So this is the kind of chart that I like to see for a bullish call or call vertical entry. And in this case, I think a call makes more sense. Potential over the next 2 weeks to have as much as a 9% rally, or just for the next week, 5.5%. Now, 5.5% puts us around 41.5, and the July 40 calls are $1.18. So if we achieve the expected move from the predictions from AI, these are minimum of $1.50, but in reality, probably closer to 2.25, maybe even a little bit higher. This has got that potential to double. That gets me more excited about the opportunity here. I like Fifth Third Bank today. It's not perfectly liquid in that it's, the markets are trading in nickels and dimes as opposed to penny markets, penny increments. But Fifth Third actually looks like one of the more attractive setups, given the push above the 100-day moving average, the hold above the May 16th highs, maybe some light resistance around 40.75, and forecast toolbox predicting higher price action here. I tend to like this setup. It's not a put credit spread because I'd have to go down to 38 or 37.5. There's not enough premium to sell a put credit spread for next week. The 38 puts are 18 cents. If that, I might not even be able to sell them for 15. I don't get a lot of premium trying to sell some out of the money puts in Fifth Third Bank. I've got to execute this via the leverage side of things, and that's where I can actually get a good return as well. So that's part of that options analytics on it. I can either sell a put for 15 cents and have reasonably high conviction that we probably don't have something that collapses financials, and Fifth Third Bank being part of it, or I go for the leverage trade, define my risk by saying I want to stop out if we get below, say, 39, 38.85, the low of May 12th, 38.83. And certainly would be taking a loss in that scenario, but expecting the implied volatility to potentially rise up during a bearish setup to help offset it a little bit. But with that potential for a double, it gets that much more intriguing to me and a potentially much more exciting setup. All right. By the way, this triggered, for those that don't use the forecast toolbox, I pulled this off of let me reload this because it's giving me a short-term error. There we go. I went over here and saw Fifth Third Bank on there, a high level of confidence with a positive vector. Got a couple of utilities on here, and I'm trying to avoid the utilities right now personally. Wells Fargo was another one for the financial sector inclined, but the upside looked more limited here in Wells Fargo relative to Fifth Third. Model grade is a positive trend. Wells Fargo does also look bullish, but not as bullish as Fifth Third. We've got some resistance here at 76.67, slightly below that level. Fifth Third just looks better on a technical chart. So going through the forecast toolbox for some, effectively using it as a watch list, and then looking for those setups that could generate some bigger returns is a avenue for success, in my opinion. I don't need to buy all of them. You know, I don't have to go and say, you know, you like Southern. Do I like Southern? The model says buy, but look at the longer term projection. It says pretty neutral. Buy today, maybe tomorrow, and then pull back. Vector over the 2-week period, pretty neutral. So yeah, maybe Southern goes up today. Maybe I can do that as a day trade. It's a low volatility stock in the utility sector, 18 implied vol. Expected move is like 1% a day. That's not nearly as sexy to me as Fifth Third Bank. All right. So, you know, kind of going through some of those names and finding the ones that look particularly attractive for the setup that I'm looking for is a crucial element. I should note for Honeywell, by the way, you know, the forecast toolbox for this week is showing general bullish, you know, expected lows around 225, expected highs around 230. And Honeywell has now got below the level projected, but it is starting to get some buying back. So maybe that's a good indication that people were willing to buy the dip here with broad market bulling, a broad market bull scenario, broad market buying coming in. I like the bounce back there. That helps me feel a little bit better. But ultimately, I need to see higher prices, not just less negative prices for a long call to make money there. SPY, let's see how we're doing on the daily or the intraday. Now that we've gotten about 25 minutes into the open, just looking for some early indications. So we had the buying right on the open, a little bit of profit taking, and now starting to buy again. It's just, you know, as I watch through this, getting above the opening tick buy around 604 could help open up some upside. And, you know, below today's low of the range tells me that people are just looking to take profits on the news. But so far, kind of blasé, nothing day, with a bull trend in place. And getting below today's low doesn't really indicate bearishness. It just means that people weren't that excited about the news that we've got today between CPI and some progress between US and China. All right. Let's go for some individual. Oh, actually, one other sector move that I just noticed here, uranium. So uranium broke out on Monday, pulled back on Tuesday, now showing bullish again. It's good for CCJ. I'm not doing anything with CCJ right now, but generally those are going to be highly correlated. If you have a CCJ position or have been looking for CCJ, really just watch uranium. There are some smaller companies that could be interesting. Energy Fuels, UUUU, hasn't had nearly the same bullish behavior so far. More of a stock trade with a $5.50 stock. UEC, another uranium company, having lagging performance here, or Denison Mines. Like, all these names have been lagging. Think of this like the way that MSTR has been our bullish case for the crypto companies being the biggest holder of crypto or biggest holder of Bitcoin, while stocks like Marathon, that again I'm long, has been lagging, but I'm looking for that to continue to play catch up, or Hut 8 that I'm long, looking for that to play some catch up here, and it started. Now I just got to see some continuation. If it does, by the way, I'm looking for, you know, Hut 8 to have some consolidation around 21.5 to 22.5. That's a big upside move. That's why I stayed with it for half of my position. I rotated the other half into Marathon with the July 18 calls. That catch up just to Hut 8 should put those 18 calls in the money, with a real target here around 22 over time. My Hut 8 position is for next week. My Marathon position is for July 18th, $18 calls. And Hut 8 is in the money. That's why I'm a little less concerned about it being next week. I'm in the $17 calls. So they're $1.50 in the money. I've got some intrinsic value. As long as the stock holds up and as long as crypto holds up, I'm okay with holding in the money call. I'd be a little bit nervous about an out of the money June call, like a 20 or a 21, knowing that those have to get the move. Hut 8, I'm mostly just leveraging a stock replacement type strategy with defined risk. So at $1.93 right now, I do have risk of about 45 cents of decay in these options over the course of the next week and a half, meaning I need to get to 1890 to maintain this value. If we start pressing higher, I'm looking for 19.5 to be a potential resistance point, but really 21.5, 22. So as long as Bitcoin continues bullish, I feel pretty confident to hold that. And I'll either roll that out or rotate it into more Marathon or Riot, which has been, a little bit more bullish here the last couple days, or BTDR. Oh, I took that off my watch list. BTDR maybe lagging a little bit more than Marathon, or just going to a completely different sector. And that's okay too, saying, yeah, you know what, maybe I just want to have a little bit less exposure in crypto if they're not moving. When they're engaged, I like having them. When they're sitting, when crypto's sitting, it's a little bit more dicey. All right, let's run through the aggressive power trader names. So right now we've got FCX, which I already addressed, Microsoft, which is breaking out as I addressed. So NDAQ, NASDAQ, the exchange loves it. We're making money for the exchange. The NASDAQ is doing well, breaking out to new all-time highs. Is it all-time highs? Let me double check that. Yeah, all-time highs here. NASDAQ is very solid. It's a low volatility stock, traditionally a lower move. Recently, we've had even lower realized volatility than the implied. The RSI is over 70. It's up to almost 78. Support should exist around 84.5 or 84. I can't really sell a put spread here because I don't want to sell the 85. I'd have to sell the 82.5 put. That's worth almost nothing. So for the bull, I think this is a spot to go out towards July. Look at the 87.5 calls, maybe into August with a call vertical, since there's a little vol premium due to earnings for a continued grind higher move, 87.5, 92.5 call spread, or a simple stock trade with a stop at 84.5. Risking $2 in NASDAQ should feel like a pretty safe hold right now. $2 is not, the normal expected daily move is about 85 cents. What are we looking at for NDAQ to do here in the next couple days? Yeah, so NDAQ, a nice looking expectation prediction here of just continued grind higher move. And if it gets to 90 as targeted in the next 2 weeks, these July 87.5 calls are worth, probably around $3.50. So similar to Fifth Third Bank, if this comes to fruition over 2 weeks now instead of over one, another opportunity for a potential double of my money, if not more. These aren't the highest liquidity stocks. I wanted to be more liquid last week in terms of the names like put credit spread than Apple and Amazon. Now I think that getting into some of these other names that are showing some interesting buying behavior starts to get that much more attractive. So got to keep an eye on them, but I think NDAQ looks pretty solid here at this point. May get a dip down towards like 86.25 today, or we might just continue firmer. That and Fifth Third Bank and, some of these other names that we've talked about do all look generally bullish. Again, the sector that I'm not seeing a lot of bullish bias out of is like utilities. That's just sideways near the lows of the range. People aren't going for the safe haven. One of our other safe havens that people have really liked for a long while is Philip Morris. And it's bullish today, but it's in a consolidation period. Not a lot of desire to get safe. It seems like the market really wants to get risky. That's why we go into tech, we go into growth. We're not going into safe haven for now. And that may shift. Again, if we start to get to a consolidation point for the broad market, we may have a shift away from risk and back into safe havens. And, it's a little back and forth, ebb and flow. It doesn't mean bearish in the short term if people start to buy utilities or Philip Morris again. It just means that some people are willing to take a little less risk right now. They don't want to go all in on the higher movement potential stocks having some stocks that have just stable increases, good dividends, and the like, which is a utilities focused play. I don't often look up at industrials, but I just want to point out here that they're also looking bullish, like everything, right? Or like not everything, but like many things. Just at the beginning of this breakout point, that could be a Caterpillar type trade. Very similar setup to the Dow Jones Industrial Average. Boeing as well has been on a tear, trading at the highs here. Longer term, we're not at the all-time highs. On the 2-year chart or the 5-year chart, you can see we've gotten up towards 280. So we're not buying the all-time high. There is going to be some resistance along the way at previous high points that have stalled out. But as long as we stay above the 20-day moving average and stay above some key support levels on a price basis or like 210, Boeing looks generally positive. And speaking of Boeing, Jets generally looking a bit positive here, but consolidating today. Within Jets, my preferred stock is United Airlines right now, showing a bit of leadership relative to Delta, although today more of a consolidation. I'd probably wait till we're back above 85, frankly, and then targeting 100. So call vertical, like a July or to August 8,500 call spread. The July $8,500 call spread is about 390. I just don't see us pushing through 100 with a ton of ease here, and $1 on those does seem justified, although it does have earnings prior to the July expiration, so got to keep that in mind. August hundreds, $2, the $8,500 call spread, about $4.50. Possibility of achieving something like a double or better in those sort of setups. So call debit spreads, again, just seem to be natural for some of these bull setups. We'll review today's big mover on earnings. Not that there was anything really to trade here, but that's Chewy down 11%. Pretty in line with the average move, but as I mentioned yesterday, I just didn't see a great setup here, given that we've had some moves around 0%, moves around 30%. It's not a predictable move size. And then, of course, it did exactly the average move size, so I guess it was more predictable than expected. The options didn't have a huge open interest on a specific strike. 40 looked like a decently big number, of 39 bigger. On the upside, was looking at 47, which was close to at the money, and then up to 52, which would have been about the same percentage move, but to the upside instead of the down. Broadly, I guess it just moved the average, which is, for better or worse, that's just what we got. And GameStop was yesterday afternoon as well. And they've been shifting some of their fundamental corporate structure, shifting to being a depository of crypto, looking to raise capital to buy crypto. And over the long haul, that may have a bullish impact or a bearish impact. I don't know. But what I did know or do note here is that shifts my expectations for how earnings moves are going to happen. They announced it right after the March earnings, or in line with the March earnings. Where are we? There we are. So had the bullish March earnings, announced their crypto thing, have been rallying somewhat since, had the spike in May 27th. Just didn't look like a good predictable move in the earnings, and seemed like almost anything could happen. And in this case, it was nothing short of almost anything. 4% down, could have been a bigger move down, could have been a bigger move up. In this case, just a small move down. Not a good earnings structure there. So this afternoon we have Oracle, and I'm just going to address why I just don't see much here. Now the average move is 11.5%. The last two moves have been about 6 and 3, 6 or 7% and 3%. Over the long haul, that 6 and 3% is a little bit more like the norm. Over the last 4 years, the average has been 6% with some 12 and 14 percenters and with some 1 and 2 percenters. Over the last 5 years, the average has been a little bit lower, 5.6%, because in 2020 and 2021, 6% was a big move. Recently, that's been picking up. So what do I really expect here? Probably somewhere between 5 and 12%. That's not a good range for me. Maybe I can bet for between 6 and 12%. Maybe I could say it's going to be between 8 and 15%. I just don't have a great feel for how big that move should be. On a support level, I'm looking like 163. That's somewhere within that range, 15 bucks, 8, 9%. Resistance, sure, this high of 192 looks like some decent resistance point, right? 14 bucks, about 8%. Options wise, the open interest, very spread. Market basically saying we don't know where we're going to settle. We got a lot of open interest at 180, 185, 190, 192 and a half, 195, 200, all the way up to 220, with big volume there today for some reason. And on the downside, we've got spread open interest again. No real magnet. Even on the serial monthly options, sure, there's some decent open interest here at 200. On the downside, I don't know, 150, 135. These don't look like numbers that I would expect to be in play for earnings. Maybe 150 could come in play if it comes out bearish. 135 would be absolutely wild. 150 just looks like it's too far down. 135 looks like it's too far down. I don't have a good enough sense of the magnitude of the move here being fine-tuned enough to have a targeted move. So for Oracle, I think it's just a let the market play it out. And honestly, I'm hoping for like an AVGO and a Palantir style drop to 170 and then set up a better trade on the bull side going forward if it wants to mimic the Palantir and what may be starting to form here in AVGO. It's not a high expected value trade to do anything earnings related for Oracle. But I will also address Adobe and Restoration Hardware for the next session, because I know some of you probably can't jump on the Thursday close, and so getting a little bit prepared for these. They have maybe a little bit more interesting setup. Adobe's been about an 11%er and expecting 7% this time, pricing in a lower than normal recent move. Maybe that does end up happening, but we've been doing 14%. We've really had a floor at 7% for about a year and a half. 7% on that floor puts us to 440. 11% on that seeming ceiling puts us up to 460. 465 would look like a big resistance point for me and tough to get above that. 52 bucks, 13%. On the downside, something symmetrical for a $47 move puts to about 365. 365 looks okay, maybe up to 375. So 375, okay, that's 40 bucks down. 40 bucks up is 455. That seems like another possibility here. I mean, that's the high here in March 5th, pretty close to the high of January 30th. And the options market is a little bit spread. It's not the most volume heavy. 450 is naturally a bigger open interest because it's a bigger, rounder number. People tend to pick 450 rather than 447.5 or 452.5. In June, we got some open interest here at 450. Again, tends to be more likely trade at rounder numbers. 450, 500 has some good open interest actually, and even though those are likely irrelevant. But here with the implied volatility at 62% and expected to fall to probably around 28% after earnings, I don't want to do a calendar. I would love to do a calendar, but the options market is not pricing that pricing that for an attractive entry on a calendar. So rather than a calendar, I look to just the butterfly trade again. If one likes the bullish side, I think targeting around 455 or 460 with a wider call fly like a 450, 460, 470 could be interesting. It's about 41. It's cheap. The 450, 460, 470 call butterfly is, got to do the math here again real quick. 467 minus 412, so 55 cents. 55 cents for a potential move to $7, $8, $9 if we actually pin right at 460. It seems like a pretty darn good R&R. And to do a symmetrical, it would basically cost double that, targeting, let's say it's 460 on the upside, and then 365 on the downside. This creates a nice symmetrical profile for about $1.10 on two $10 wide butterflies that have, I think, some significant return potential. Nothing's ever guaranteed, but I would love to see then that 12% move, and 12%, slightly lower than last time or last couple. Anywhere between 10 and 14% looks pretty good in that scenario. Really, anywhere between about 9 and 15% looks pretty good in that scenario. So take it for what it's worth, but I think Adobe looks a lot more attractive given some general technical levels in there, in addition to a more standard magnitude move recently. And then Restoration Hardware. So Restoration Hardware certainly impacted by tariffs and just general concern. I think a lot of their retail stuff has been made out of, I think it's out of China, but it is Canadian stock, so that should be benefiting them with EWC. Sort of tongue in cheek on that. The last move was down 40%. But the normal move, it's been pretty predictable. The last move was an outlier. We're normally looking around that 17, 15% type range. Anywhere between 14 and 17 with one outlier upside here of 25%, one outlier downside of 40%. But if I target a 15% move, I'm effectively looking for $30. Now, $30 to the downside is 155. Kind of around this April 16th, 17th, 18th low. To the upside, 215. Little bit below these recent highs. Implied volatility honestly should probably be dropping down towards 54%. Right now, next week's options, 132%. We're just looking for a lot out of earnings, a big move in earnings, and then a collapse in the implied volatility. So when we expect a big move on earnings and then a stop, the calendars just don't really play out very well. So again, I'm back to the butterflies, looking for maybe that 215 level could be a interesting. Yeah, that 215 level seems like an interesting target. It's about $30. Maybe we have a bigger move here, much like we saw in Lulu, where they've been impacted by the tariff stuff more than others. We ran up and then dropped down to basically to the April 22nd-ish level. And again, comparable in our Restoration Hardware, if we're going to go to that target zone, it's about 155. So kind of like that for the double fly here. Down to 155, up to 215, staying a bit wide here, 165, 155, 145 on the put fly. That's currently priced out at a 38-cent credit. That's about 90 cents for the put fly. So it's not cheap, not as cheap as Adobe. 215 on the call fly, 736. Oh, wow. Yeah, I guess they're looking for more upside than down here with the magnitude of that. But in any case, 1002, 260 credit, about 70 cents for the call fly. So $1.60 for the two $10 wide put flies. It looks okay. I think Adobe has more leverage. Restoration Hardware just has a secondarily decent look to the setup. All right. So that's basically what I've got for today. Hope for you guys. You know, those are those earnings plays that we talked through some forecast toolbox projections. Honestly, I think the best trade I see today is probably Fifth Third Bank. NASDAQ, decent. Maybe a put credit spread and something like AVGO or a call debit spread there to target the previous highs, and now we're up $5. So may have moved away from it a little bit, and now looking for the call debit spread since the puts credit spread is going to get a little bit too cheap. But there's still some leverage to those call debit spreads. Just for me, I think Fifth Third is my best idea of the day with those July $40 calls. All right. If you guys have any other questions here, I'll address them now. And if not, I will be back on for the closing bell tomorrow. We'll see if Vlad has an idea for Oracle earnings or for any other names in the market today. But that's kind of the brunt of it for me, is generally bullish behavior. And even my Honeywell is now almost back to unchanged. So maybe we start to see some people feeling like they missed the opportunity to buy Honeywell or GE on this recent dip and start to get more bullish back there again. Folks, oh, this one popped up for me just now. Haven't looked at that too closely recently, but Rigetti starting to get some more love as well, like these quantum computing companies, IonQ and Rigetti, you know, some of that risk on behavior starting to come back in. QBTS is another one there to watch. Hasn't participated as much yet today. Maybe that's a sign that it has to catch up, because these are not names like QBTS only trades 100, 200 million shares a day. So maybe just got a little bit forgotten. You know, the options trade more than the underlying, frankly. You know, this right here represents 500,000 shares. On volume today of, you know, a couple 20 million. See some of the statistics. Yeah, we've already gotten some definite call buying here. People trying to get positioned here in QBTS, it looks like, before moving the stock, as these June 20s get bought up pretty aggressively, or this week's 19s. That could be an interesting one for like an outlier potential move. Looks like we're getting some serious call buying in expectation that it catches up to the IOMQ and Rigetti moves that are already happening today. So yeah, NVIDIA CEO sees inflection point. Now that might be part of their stall here. Sell up to $400 million in shares from time to time, whatever that parameter means. But that puts a little bit of weight on the company or on the stock when you got 20 million shares, 20 to 25 million shares to sell to raise capital. I'll probably hold off on this one for now and just focus on the others. What's QUPT? Is that another quantum? Yeah, that is quantum. Another low volume quantum stock getting a little bit wild here for those that like those wild setups. So, you know, take it for what it's worth. I don't have a strong opinion on QUPT, but maybe it gets interesting. All right. Thanks again, everybody. I'm gonna jump, and I will see you guys at the closing bell tomorrow. Best of luck today, and I hope you've all got some good trade ideas that you're working on, and maybe some new ideas pop into the brain today from our conversation. So thanks again. Have a great afternoon.